Hey there! Every month I ask my patrons on Patreon and channel members right here on YouTube to ask burning questions about stocks, the markets, technology, and almost everything else. Well, it turns out that this is the 12th Q&A episode, so to celebrate 1 year of doing these, I figured I'd take the toughest 5 questions and share my answers with everyone. I want to give a huge thank you to everyone who goes out of their way to support the channel, especially during such crazy times in the market. I'm a better investor and content creator today because of you. Your time is valuable, so let's get right into the questions. Tom asks, ARK Invest has lost around 70% of their value from their peak. They've been going straight down for months. How much more do they have to go down before you stop talking about them? Will you ever lose faith in Cathie Wood and her team? So I actually get this question a lot, and I totally understand where it comes from. Let me tell you a quick story that really ties into this. Back when I worked at MIT's government lab, we were broken out into different divisions and then groups within those divisions. So there would be a space technology division, and inside it there would be a sensors and signals group, a systems engineering group, and so on. So for example, when somebody solved a weather modeling problem, they could take that solution and implement it in a wide variety of projects across a large number of clients. A lot of different programs used weather models to do a lot of different things across a wide variety of programs. Same is true of other areas of engineering, like radar signal processing, 3D printing, robotics, and so on. MIT's groups are organized by technologies, which is actually pretty different from how most companies get organized, which is usually by product, by service, or by customer. ARK Invest is set up almost the same way as MIT's government lab. Their analysts focus on technology platforms, not market sectors, not industries, and not geographic regions. They focus on things like genomics, mobile robots, crypto assets, artificial intelligence. These are technology platforms, foundational building blocks that touch a lot of different businesses in a lot of different ways. And as a result, they're analyzing the market in a very different way from the rest of Wall Street. I really think that their strategy is the right way to find the big winners in tech, even if it's not the smoothest ride getting there. The channels who told you to buy something just because ARK Invest bought it didn't do anyone any favors. That's why I focus on diving deep into the technologies behind these companies, the science behind the stocks, and connecting that back to ARK's trades. I would lose a lot of faith in ARK Invest if they change how they go about doing their investment research, or go in a very different direction from their current investing strategy. Which leads us right into the next question. Pure Life asks, what do you think about Cathie Wood's position that Teladoc is still a great investment for the long term? So I actually have mixed feelings on Teladoc right now, and I'm saying that as someone with around $100,000 invested in the company. Ugh, pray for me. I think it's important to call out that this isn't me flip-flopping on Teladoc just because the price went down. It's because my investment thesis got challenged during their most recent earnings call, and I think so did Cathie Wood's. On one hand, the human body is interconnected, so an integrated end-to-end healthcare solution for patients can offer a lot of different care plans and products and bundles that a more targeted solution may not be able to. I also believe that the real story could be on the business-to-business side, where Teladoc can build the infrastructure that connects doctors, insurers, and hospitals across the entire medical value chain. There's a lot of medical work that patients don't see. Anyone that says Teladoc is just Zoom for doctors probably heard that somewhere, thought it was clever, and just ran with it. That's really not what the company does at all. It's kind of like saying Teslas are just cars with batteries. You're really missing the entire investment thesis when you say it like that. But after their most recent earnings call, I'm not sure how deep Teladoc's moat really is. If Teladoc's mental health solutions are having a hard time competing against other, smaller companies that only focus on mental health, then what's the real advantage of being part of Teladoc's larger healthcare ecosystem? The same can be said about their chronic and acute care solutions. Teladoc having to spend more on marketing in the face of increased competition is something that just happened this past earnings call. I'd have the same questions whether their stock ended up going up or down. Specifically, my question is, why spend the extra money acquiring and integrating these different solutions if they're not giving you a competitive advantage? That's something we'll find out over the next few earnings calls as they keep gathering more data and keep integrating all of their services together. Gordon asks, what's your favorite stock right now that ARK Invest doesn't hold? Well, ARK Invest no longer holds Palantir, so that was easy. I'm just kidding. My actual favorite stock that ARK Invest doesn't hold is a company called CleanSpark, ticker symbol CLSK. CleanSpark kind of has two parts to it: energy solutions for sustainable Bitcoin mining, and energy solutions for commercial and residential microgrids. Microgrids are exactly what they sound like. They're much smaller, self-contained grids that connect energy production, storage, and consumers. For example, solar panels, home battery backups, and the buildings that use them can form a microgrid. Microgrids let homes and large campuses operate even when the main electric grid is down or overloaded, so they provide energy security and redundancy. But these microgrids can also be optimized in a wide variety of ways. A homeowner might want to store their excess energy and sell it back to the grid at peak prices when demand is at its highest. But a hospital probably cares about having as much uptime as possible, so their microgrid would be optimized for storing energy and keeping the lights on no matter what, because patient lives are at stake. So CleanSpark's energy management technology sets up microgrids to meet the actual energy requirements of each specific user, revenue, uptime, and so on. Okay, one of the most energy-intensive things you can do right now is mining Bitcoin, and it turns out that CleanSpark's decentralized energy solutions are a great fit for Bitcoin's varied and decentralized mining needs. The trade-off here is now their profits and their stock price correlate more with Bitcoin. So CleanSpark stock is super volatile, and I'm not saying you should go buy it right now, especially if you're not interested in assets that correlate to Bitcoin. I'm just saying it's one of my favorite renewable energy and crypto plays that ARK Invest surprisingly doesn't hold. And speaking of stocks that ARK Invest doesn't hold, John asks, what's the deal with you and Wejo? It seems like you're pumping that stock pretty hard. The data they collect must be lower quality than Tesla's, right? Do they really compete with Tesla in any way? You know, I think it's pretty cool that people think this channel is big enough to pump anything. Here's the deal. Forget about autonomous vehicles for a second. Cars actually have a ton of sensors in them and record a ton of data. All of this data is useful, or else businesses wouldn't spend the money putting sensors in to collect it. The real question is there a business use case for it beyond the way it's currently being used? It's not about high quality versus low quality. That's a bad way to think about Tesla versus Wejo. It's about Tesla collecting data to solve Tesla's needs versus Wejo collecting data to solve the needs of many other players in the auto industry. So why would anyone else want this data? One clear example is looking at all of the locations of cars with their windshield wipers on to help understand weather conditions and road conditions in real time. Another would be seeing how much time electric vehicles spend plugged in versus how much time they actually spend charging. Well, it turns out you can generate a lot of real business insights with all of this low-level sensor data. So collecting, standardizing, combining, analyzing, and reporting this kind of car data across a wide variety of manufacturers is useful to a ton of different organizations: government, infrastructure, logistics, media and advertising, mapping, traffic management, real estate, retail, insurance. The list goes on. And what Wejo is doing is getting all of this data together and building a marketplace and a platform to help other organizations access it and build other apps and services on top of it. Wejo's partnerships with Palantir and Microsoft help them do this in real time and at large scales. One of the many use cases for all of this data is training for autonomous vehicles. Another one is identifying where and when electric vehicles are actually charging. A third is usage-based insurance. All of these are markets where Tesla is currently in. So what Wejo does is help other insurers and charging providers and car manufacturers serve these same huge markets. During my first and second interviews with Richard, I asked all of the tough business questions I could think of. We talked about their unit economics, their business model, and their moat. So with this latest interview, I just wanted to talk about some of the cool new stuff that they're doing. It's really as simple as that. And by the way, if you're an executive of a publicly traded tech company, I'm always interested in talking to you and helping other investors understand what it is you do. So slide into my DMs because they're open. Steven asks, what would be the signal for you to deploy all of your funds into the market? Interest rates dropping, the war ending, China becoming a democracy, inflation stabilizing at 1.5%? What would it take? So I thought about this question a lot, and I think there's actually two parts to my answer. First, I don't think I'll ever deploy all of my funds into the stock market. You may not know this about me, but I only invest in high-tech, high-volatility growth stocks. Oh, you already knew that about me? Well, if that sounds crazy to you, you're absolutely right. Or you would be if that accounted for all of my investments. I diversify my assets outside of the stock market, not inside it. I have about 5% of my assets in crypto, 25% of them in real estate, and around 50% in late-stage private companies. That leaves around 20% or so in growth stocks, more than half of which are in retirement accounts that I can't touch for another 3 decades. This is why I have no trouble investing in newly public microcap companies like Wejo. That's actually right around the part of the company lifecycle that I really like investing in, and it's a great place to leverage ARK Invest's research on technologies and macroeconomic trends. Alright, so how come I never talk about my private investments? Well, most of the money I have in private equity comes with non-disclosure agreements, and almost every funding round I was a part of had a $250,000 minimum. So I literally can't talk about them, and even if I could, almost no one would care because of that minimum investment size. In my opinion, that's just not good content, so I focus on sharing information that my audience can actually use. With that said, when these private companies go public, I'll technically have over 70% of my assets in public growth stocks, and that's obviously not where I want to be. So I'll begin looking at private placements in Series B or C funding rounds again. So if you're an executive at an early stage tech company, I'm always interested in talking to you. And if you have an open cap table, I'm happy to have you on and help other investors understand what it is you do. My DMs are open. I think if the war ended, inflation went negative, and interest rates dropped back to zero, I could be convinced to put more of my money in the public markets, but it really depends on what's going on out there. Alright, now let's assume I did want 100% of my money in the stock market. I'd still never fully deploy my funds. You always want to keep cash on the side because there are always new opportunities coming online inside the stock market. For example, let's say that Stripe finally goes public. I definitely wouldn't want to have zero cash when that happens. Let's say Microsoft announces that it's acquiring another company like Blizzard Activision. That's a massive change in the market, and I want to have cash available for when that happens. Or let's say something even crazier happens, like Elon Musk decides to buy Twitter. There are all sorts of non-macro reasons to have cash on the side, which is why I always talk about dollar cost averaging and building positions over long periods of time. And speaking of long periods of time, here's the 5th and final question. Brian asks, I understand that no one ever knows the future, but given the challenging times we're going through today, how likely is it that these stocks can languish for many years or even decades before growing exponentially? This is a really important call out. It's entirely possible to see growth stocks languish for 2, 3, or even 4 years without it being a total shocker. We're coming off of some of the richest valuations of all time. I'd say that growth stocks languishing for a decade or more is a bit of a stretch though. A lot of people are comparing right now to the dot-com bubble, but one thing that's changed between then and now is the internet. There's a lot more information out there, a lot more people analyzing that information, and a lot more of those people sharing their findings. It's also just a lot easier and cheaper to buy and sell stocks than it was 22 years ago. What that means for companies is that there's a lot more potential investors for their business, which means easier access to capital overall. A lot of friction got taken out of investing over the last few years, and now it's a lot more about finding great companies at fair prices. It was a lot harder to really do that during the dot-com bubble. Still, let's use that as a reference point and take one of the worst cases as an example. Let's look at Microsoft's total returns over time. If you put $1,000 into Microsoft at its IPO in the 80s, you'd have over $2 million today, even after its 27% drop from the recent peak. But if you bought it at the peak of the dot-com crash and sold it today, you'd only have 4x your money over about 20 years. That's way worse than just being in an index. In fact, if you bought Microsoft at its peak at the dot-com bubble, it would have taken you almost 17 years just to break even. Yikes. That's a great example of paying the price of buying at the top. But no one can argue that Microsoft was one of the best companies that you could invest in. So here's one of my favorite quotes from Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That's all any long-term investor is trying to do. Buy wonderful companies at fair prices. This channel is more about finding wonderful companies and understanding what they do, especially if they're involved in advanced technology. I believe there are a lot of great companies out there that are misunderstood by the market, and misunderstood companies means mispriced stocks. So I create content around these misunderstandings. Roku, Palantir, Teladoc. There are already tons of great YouTube channels and other resources to help you decide on fair prices. And more than that, the actual timing of the buys and sells really depends on you, your reasons for investing, and your own time horizons. That's not a cop-out, guys. If you're 25 and just getting started, your portfolio should look really different from somebody who's 55 and thinking about retiring. If you have kids and you're trying to help pay for their college, your portfolio should look very different from someone who just wants more spending money without picking up a second job. The median age of my audience is 47 years old. 47. So my content is really geared towards somebody who takes care of their household needs first and understands how to manage their money responsibly. I also believe that good content creators shouldn't time their content around stock market prices unless the content is about the price specifically. When I make a video about a company, I'm not implying that when I publish is the right time to buy. It's just what I was researching at the moment, and that's why I'm talking about it. That's why I'm always going on and on about dollar cost averaging. It's one of the easiest ways to protect your portfolio from impulse buys and sells. That's literally as close as it gets to a one-size-fits-most solution. Going back to the Microsoft example, if you bought at the peak of the dot-com bubble, you probably didn't buy very many shares since they were very expensive. If you're constantly averaging in the same amount of money, you get more shares at lower prices. That puts you in a win-win situation. If your stocks go up, you're happy. And if your stocks go down, you're about to get more shares at a better price. That's really all there is to it at a high level, and for more specific advice, you should consult a financial advisor and ask them about some of your favorite companies. It's hard to believe that I've been doing these Q&A episodes for a year now. Thanks again to my wonderful patrons on Patreon and channel members right here on YouTube. I appreciate all of your wonderful questions, feedback, and support. And for everyone else, let me know in the comments if you like these types of episodes or if I should just stick to making deep dives and analyzing ARK Invest trading data and keep these types of Q&A episodes as contents for members only. Either way, thanks for watching, and until next time, this is Ticker Symbol U. My name is Alex, reminding you that the best investment you can make is in you.